So this one is going to be a recording on an overview on bond accounting. And I want to incorporate notes payable with this recording here just because there are some similarities between bonds and notes. Just because bonds can be very complex as far as with trying to comprehend what bond accounting is. So a bond is similar to a note. A note is a promise to pay back a specific amount by a specific date plus interest. That's what a note is, or specifically a promissory note. If you do have a car and you're financing that car, you probably have a note taken out for that car. So you're financing that car with a note. And when you make cash payments towards that note, some of the amount or some of that payment is going to go towards the principal balance on that note plus interest. And you're making those payments periodically. So you're making those payments every single month. So that's a note. A bond, it is quite similar. Instead of you actually paying back the principal balance, it's just the words, principal balance. So the loan amount, you're paying back the par value or the face value. So I want to say that's synonymous to the principal balance on a note, the par value or a face value or the face value of a bond. And the bonds also have interest as well, because bonds are just IOUs from either the government or corporations in exchange for cash. So they have interest as well. Same with notes. You got to pay the principal balance back on the note plus interest. Now, the clear difference here between a bond and a note is how you account for bonds and notes. So when it comes to a note, like I mentioned, whenever you make cash payments on a note, part of that payment is going to go towards the principal balance, and then the other part is going to go towards the interest. And you're doing this periodically. So the accounting for this is going to be demonstrated quite frequently in the company's books. Then the bonds, then how you account for bonds. Now, bonds, when you're actually making cash payments on the bonds, the payments that you're making on the bonds is going to occur less frequently than making payments on a note. So the cash payments that are made on bonds are made twice a year, but those cash payments are going towards interest and not the face value or par value of the bond. So once a bond reaches its maturity date, that's pretty much at the end of the time that you can actually have the bond, or when the bond expires, we can say. That's when you're going to make a cash payment towards the face value or the par value, equivalent to the principal balance of a note. So that's the difference there. And you can imagine that accounting for bonds is going to be different than accounting for notes when you're recording the entries or transactions in a company's books. Okay, so this next slide here, it's what I mentioned partially in the first slide, that bonds require the issuer to make semi-annual interest payments. So that's twice a year. So whenever a cash payment is made, it's going to all go towards interest, and you're doing that twice a year. And the interest, it is calculated by multiplying the par value by the bond's contract rate. So when you have a bond, the bond has an amount. That amount is the par value or face value, equivalent to a loan amount or the principal balance displayed on a note. And it's going to also have a contract rate. Contract rate is also the same as a stated rate or also the coupon rate. So they have so many different names. Contract rate, stated rate, or coupon rate, they are all the same. That's going to be displayed on a bond. And that's the rate that's going to be applied to the par value, which is going to determine the interest that needs to be paid. Okay. So last slide here. Advantages of bonds. So issuing bonds does not give away ownership of a business. So this is the same as a note. So bonds payable, it is a liability. Notes payable, also a liability. So that doesn't affect equity at all, which doesn't affect ownership of a business at all. Okay. So that is definitely an advantage because although it's a liability, you didn't have to give up any equity or ownership in a business, which is why it is a benefit or one of the benefits of issuing a bond. Next, we have interest on bonds is tax deductible. Well, yes. So whenever you do make a cash payment, it's going to go towards the interest. Well, that interest is going to be interest expense, which is a business expense, which is tax deductible. So you can actually claim that as a deduction on your tax return. So that's another advantage. Similar to a note, you could do the same thing with the note. Interest on notes is tax deductible as long as it's for business purposes. Bonds can increase return on equity, same as a note. It just depends on how you use the cash that you're receiving from issuing out the bonds. So if you're using that cash to acquire another asset that can potentially be a revenue generating machine, oh yeah, it can be definitely increase the return on equity because revenue is a part of equity. And yes, it would definitely be a positive thing if you're investing or using that money in something that's going to provide you future economic benefits. No different than a note. A note can also increase return on equity. Again, it just depends on how you use that note. Now, the example that I use about a car, that's going to be different because if you took out a note to finance or purchase a car, then that's not going to really affect equity unless you're using that car to generate you revenue or income at the end of the day. So if you're using that car, for, let's just say for a driving service like Uber or Lyft, then yeah, because that car is it really is your asset because that's actually, you're using it to generate money at the end of the day. So that can increase return on equity. So it depends on how you use it. So you can also take out a note, or you can issue out a note in exchange for cash, and that cash that you receive, you using it for business purposes, something to grow your business or expand your business. So that can also increase return on equity. So again, I wanted to just do a short overview on bonds and just demonstrate you all a little bit of the similarities between bonds and notes because they are quite similar.